What is DeFi? If you're new into the crypto space, you may be hearing the term DeFi and you're asking yourself, what does that even mean? So let's get right into it. DeFi is short for decentralized finance. It's a fast growing sector of the cryptocurrency industry. While regular blockchain projects create a decentralized store of value separate from any government backed fiat currency, DeFi projects create decentralized financial instruments separate from traditional centralized institutions. So, for example, a centralized institution would be like your bank, a Chase, Bank of America, Wells Fargo. These institutions, they hold your assets to let you borrow money. You can't really lend, but you can borrow money from the bank and things like that, and they'll charge you interest rate and things like that. Now, what DeFi is basically a peer-to-peer lending. So since crypto is decentralized and not owned by any one person, you can now use your crypto to then lend to somebody else, or if you have crypto, you can actually put your crypto as collateral and you can borrow as well. So how does DeFi lending work? Value lock. Value lock represents the total number of users, deposits in a protocol smart contract. IOU token. Lending protocols issue users IOU tokens against their collateral deposits, like Bitcoin, Ethereum. Collateral. A loan's collateral represents the entirety of a part of a borrower's deposit against the loan. Now, when you're doing borrowing, you can get liquidated. You get a certain amount of interest rates you have to pay back, or you get a certain amount of yield. So let's look at what this looks like in actual practice. So Radium is a protocol that allows you to do DeFi. So you can actually provide liquidity to a pool, and then because you're providing liquidity, they will give you a percentage of those fees. So for example, let's say you have Solana, and let's say you have USDC. You can pool those two together. Let's say you take $1,000 of Solana, $1,000 of USDC. Total value is $2,000. You can add it to the pool. So anybody who's looking to buy or sell Solana, they can actually go into this pool to help, transfer, make that exchange. Now, for making that exchange, you have to pay a fee, and because you provided liquidity to the pool, you get a portion of those fees. So, for example, this Solana USD pool has about $56 million in this smart contract that allows people to buy and sell Solana in it. Now, with that being said, in the past 24 hours, they've gotten about $82,000 worth of fees, and that yield is breaks down to about 65%. So you're getting rewarded for providing liquidity to this pool so people can buy and sell Solana. Now, the larger percentage of the pool you have, the more of the fees that you're going to have. For example, if you had 1% of the pool, you get about $800 worth of those fees. But in order to have 1% of the pool, you need to have about, what is that, $500,000 worth of USDC and Solana. So this is just an example of how liquidity pools are created and how you can actually get yield for providing liquidity in a decentralized platform by putting your crypto as collateral or offering it for people can buy and exchange, and then you would actually get the reward of the fees that go along with it. So that's basically a quick example of DeFi. My name is Sam. This is the Crypto Culture Crew. If you like this type of content, please like, subscribe, and share, and we'll catch you next time.